The Psychology of Investing by John Nofsinger. The psychology of investing explores the cognitive, emotional, and social factors that influence investor behavior, often leading to irrational decisions. Nofsinger emphasizes that understanding these psychological influences is critical for investors seeking to improve their decision-making and avoid common mistakes. The book combines insights from behavioral finance with practical advice, helping readers recognize the psychological traps they may fall into when investing. Key concepts of behavioral finance. Nofsinger begins by introducing the field of behavioral finance, which integrates psychological theory with traditional finance, to explain why investors do not always act rationally. Unlike classical economic models, which assume that investors are fully rational and always act in their best interest, behavioral finance acknowledges that human emotions, biases, and social influences can lead to irrational financial behavior. Nofsinger explains that investors often fall prey to biases and heuristics, mental shortcuts that simplify decision-making but can lead to errors. By understanding these common psychological tendencies, investors can mitigate their negative effects and make more informed decisions. Common psychological biases in investing. Nofsinger outlines several key cognitive biases that frequently affect investors. 1. Overconfidence bias. Many investors overestimate their knowledge and ability to predict market trends. This overconfidence leads them to take excessive risks, trade too frequently, or fail to adequately diversify their portfolios. Overconfident investors may believe they have special insight into the market, but research shows that frequent traders often underperform compared to those who trade less. 2. Confirmation bias. Investors tend to seek out information that confirms their existing beliefs and ignore information that contradicts them. For example, if an investor believes a particular stock will rise in value, they may only pay attention to news that supports this belief, while disregarding negative reports. This bias prevents investors from making fully informed decisions and can lead to poor outcomes. 3. Herding behavior. Investors are often influenced by the actions of others, particularly during market booms and busts. When everyone else is buying a particular stock, it can create a fear of missing out, FOMO, prompting individuals to follow the crowd even if the stock is overvalued. Herding can contribute to the formation of bubbles and lead to significant losses when the bubble bursts. 4. Loss aversion. People tend to experience the pain of a loss more acutely than the pleasure of a gain of the same magnitude. As a result, investors often hold on to losing investments for too long in the hope that they will rebound, rather than cutting their losses and resources to more promising opportunities. Loss aversion can also make investors overly cautious, preventing them from taking on necessary risks to achieve their long-term goals. 5. Anchoring bias. Investors may fixate on a particular price or piece of information, using it as a reference point for future decisions. For instance, an investor might anchor on the purchase price of a stock and refuse to sell it at a loss, even if the stock's future prospects are poor. This fixation can lead to irrational decision-making and missed opportunities. The role of emotions in investing. Nofsinger delves into the emotional factors that influence investment decisions, particularly fear and greed, which are the two dominant emotions in financial markets. Fear. Fear tends to take hold during periods of market decline or volatility. It causes investors to panic and sell their assets at the worst possible times, often locking in losses. Nofsinger explains that fear can also lead to recency bias, where investors place too much weight on recent events and assume that a downward trend will continue indefinitely. Greed often drives investors to take excessive risks in the pursuit of high returns. During bull markets, greed can lead to speculative bubbles, as investors ignore fundamental valuations and buy assets at inflated prices in the hope of quick profits. When the bubble eventually bursts, the ensuing panic can lead to severe losses. Nofsinger emphasizes that controlling these emotions is crucial for making sound investment decisions. He advises investors to adopt a disciplined approach to investing, one that focuses on long-term goals rather than short-term market fluctuations. The social side of investing. In addition to cognitive and emotional biases, Nofsinger discusses the social aspects of investing. Investors are not isolated decision-makers. They are influenced by the opinions and behaviors of others, whether through direct interactions or the broader media landscape. Media influence, financial news, social media, and online forums can have a significant impact on investor behavior. Sensational headlines or viral trends can create hype around certain stocks, leading to irrational buying or selling. Nofsinger warns against relying too heavily on the media for investment decisions, as it often emphasizes short-term market movements rather than long-term fundamentals. Social comparison. Investors often compare their performance to that of their peers, which can lead to feelings of envy or inadequacy. This desire to keep up with the Joneses may prompt individuals to take on more risk than is prudent in an attempt to outperform others. Nofsinger suggests that investors should focus on their own financial goals and risk tolerance, rather than worrying about how they measure up to others. Behavioral pitfalls and strategies for improvement. Nofsinger provides practical advice on how to avoid common psychological pitfalls in investing. He suggests several strategies to help investors manage their emotions and biases. 1. Diversification. One way to mitigate the impact of emotional decision-making is to build a diversified portfolio. By spreading investments across different asset classes and sectors, investors can reduce risk and limit the damage caused by poor decisions in any one area. 2. Set clear goals. Having a long-term investment plan with specific goals can help investors stay focused and avoid being swayed by short-term market movements. Nofsinger recommends that investors regularly revisit their financial goals and ensure that their investment strategy remains aligned with those objectives.
3. Limit trading. Excessive trading is often driven by overconfidence or the desire to react to short-term market events. Nofsinger advises investors to resist the urge to trade frequently and instead adopt a buy and hold strategy, which allows them to benefit from long-term market growth. For monitor biases, investors should actively monitor their own behavior for signs of cognitive biases. By being aware of common traps like overconfidence, confirmation bias, and loss aversion, investors can take steps to counteract these tendencies and make more rational decisions. 5. Consult a professional. For those who struggle to manage their emotions or biases, working with a financial advisor can provide an objective perspective. Advisors can help investors stay disciplined and avoid making impulsive decisions based on fear or greed. Conclusion. In the psychology of investing, John Nofsinger highlights the significant role that cognitive biases, emotions, and social influences play in investor behavior. By understanding these psychological factors, investors can make more rational decisions, avoid common mistakes, and improve their long-term financial outcomes. Nofsinger's practical advice encourages readers to adopt a disciplined, goal-oriented approach to investing, while staying mindful of their own emotional and cognitive tendencies.